Welcome to The Explainer. Today, we're diving into an absolute powerhouse in the electronics manufacturing space, Syrma SGS technology. Now, if you follow the EMS sector, you already know it is incredibly competitive and highly sensitive to global supply chains. But Syrma, they just posted some absolutely explosive numbers for the first quarter. More importantly, they're making a massive strategic pivot right now, a true keystone investment in a new PCB plant that is fundamentally designed to secure their future in a pretty volatile world. So let's jump right in and see exactly how they're transforming their business from the ground up.
First off, just look at this number, plus 112%. That is Syrma's year-over-year growth in profit after tax for Q1 FY27, coming in at a staggering 106 crore rupees. Listen, when a manufacturing company doubles its profits in a single year, you have to pay attention. We aren't talking about a software startup here. This is a company dealing with physical goods, complex global supply chains, and actual factories. Hitting a 112% growth rate in profitability is a sizzling start to the year. It really proves that their shift toward higher value programs like exports and original design manufacturing is paying off in a massive way. Now, you might be wondering, whenever you see a massive spike like that, is this just a fluke? Well, Syrma's management was actually really quick to address that on their recent con call. They called it a lovely, strong first quarter, and were super explicit, stating there has been no one-time transaction. That's a direct testament to organic, structural growth. In their own words, these are normal, run-of-the-mill numbers for their current operational tempo. And it's not just the bottom line, right? The top line is moving just as aggressively. Revenue made a 67% year-over-year leap to 1,604 crore rupees. This is broad-based growth coming from all across their diversified portfolio. We're talking high-volume consumer electronics, automotive components driven by the whole EV boom, and high-margin healthcare tech. The demand for their manufacturing capabilities is undeniably robust. In fact, their CEO personally stated he doesn't foresee demand being a constraint at all. But that actually brings us to the real twist in our story today. Because while the demand and growth are clearly there, beneath all this incredible momentum lies a very critical hidden vulnerability. Let's get into Section 1, the hidden vulnerability, supply chain bottlenecks. So, because Syrma operates globally, they are hugely exposed to geopolitical shocks. Management identified their primary risk right now as supply chain constraints directly stemming from the conflicts in the Middle East. They're facing severe shortages of the specialty chemicals required for manufacturing PCBs, extending component lead times, and basically a situation where the entire industry is being forced to build up inventory just to survive the delays. When ships have to reroute, the entire global electronic supply chain feels the pain, and Syrma is sitting right in the crosshairs. But they aren't taking this sitting down. To prevent customer disruptions, Syrma has literally set up a war room to monitor component shortages, and this is operating right at the chief marketing officer's level. They're treating inventory as a strategic asset now, deliberately accepting higher working capital and longer inventory days, which push their net working capital days up from 63 to 71, just to make absolutely sure they have uninterrupted supply. It's active crisis management, and it really highlights the incredible tension of relying on global supply networks. Which brings us to the fundamental vulnerability underlying Syrma's entire business model. Currently, they import 60% of their material requirements. Think about that for a second. Over half of what they need to build their products comes from outside India. Not only does this expose them to the shipping delays and chemical shortages we just talked about, but it creates a massive foreign exchange fluctuation risk. If the currency swings the wrong way, their margins take a direct hit, no matter how efficient their factories are. So, how does a smart, fast-growing company solve an existential supply chain threat? They build the solution themselves. And that is exactly what we're covering in Section 2, the catalyst, a 15,950 crore rupee masterstroke. Syrma announced a massive 15,950 million rupee investment over the next 6 years. And to be clear, this isn't for just another basic assembly plant. This staggering sum is going toward a brand new multi-layer printed circuit board, or PCB, and copper-clad laminate manufacturing facility. This is the keystone. By investing heavily to make the foundational building blocks of electronics right at home in India, they're taking direct control of their own destiny. And they're moving incredibly fast on this. Equipment deliveries are starting this October. They plan to have the power on and be running initial operations between January and March. And by April 2027, they expect to hit commercial production. They are already 65 to 70% complete with the building itself. They know the market can't wait, so they are sprinting to get this foundational capability online. Which leads us perfectly into Section 3, Strategic Breakdown, why this facility matters. Why does this PCB plant matter so much? Because it represents a massive shift from being just an assembler of parts to becoming a foundational, deeply integrated manufacturer. This plant is the ultimate solution. Currently, they rely on 60% imports, suffering from severe forex risk and those geopolitical chemical shortages. But this new facility provides deep backward integration. It means when they need a complex, multi-layer PCB, they don't have to wait for a ship from across the world. They literally make it themselves. It dramatically reduces their own import dependency, and it offers reduced import dependency for the broader domestic industry they serve. It turns their biggest weakness into a proprietary strength. Plus, the financial payoff for this security is absolutely phenomenal. At full ramp-up, with an expected utilization of 80% or more, this new PCB plant targets an EBITDA margin of 15 to 18%. Remember, standard electronics manufacturing can be a pretty low-margin, high-volume game. Syrma's overall EBITDA margin guidance for FY27 was 10.5% to 11%. So, injecting a massive new revenue stream that operates at 15 to 18% profitability, that will completely shift their financial profile upwards. It's highly lucrative backward integration heavily supported by government manufacturing subsidies. But hey, you don't have to just take Syrma's word for it, or mine. When a company announces a multi-billion rupee capital expenditure, financial institutions pay very close attention. And the verdict is already in. Let's look at Section 4, Third-Party Validation, the Rating Upgrade. India Ratings and Research just upgraded Syrma SGS's long-term bank facilities to end AA with a stable outlook. This is incredible objective proof that their strategy is totally sound. Ratings agencies are notoriously conservative, right? They look for risks, for over-leverage, for vulnerabilities. The fact that Syrma received this upgrade right as they're embarking on a massive capex cycle speaks volumes about the underlying health of their business model. So let's look at exactly why they got that upgrade. The drivers are fantastic. India Ratings noted their robust 31.5% compound annual growth rate in revenue. They also praised the fact that, despite the whole war room situation and the supply chain chaos, there hasn't been a dangerous runaway increase in working capital. But most importantly, the agency noted Syrma's strong internal cash accruals and unutilized IPO funds. That means they can safely support this massive 15,950 million rupee PCB expansion without drowning the company in risky external debt. They actually have the cash engine to fund their own evolution. So, here is where we stand. Syrma has built the war room. They are posting 112% profit growth. They've laid the groundwork for a massive PCB facility that solves their biggest import vulnerabilities while simultaneously boosting their margins. But as their own management said regarding their growth strategies, it's not a sprint, it's a marathon. Setting up a complex, multi-layer PCB plant is incredibly difficult. So the question is, can they execute a marathon of this scale, get the plant powered on by next year, and achieve commercial production without stumbling? It is the ultimate execution test, and it's exactly what makes Syrma SGS one of the most fascinating companies to watch right now. Thanks for joining me on this explainer, and I'll catch you next time.